broadly speaking, REITs have been around for a long time. It's obviously started off in the US and it was largely driven by the tax benefits and the flow of institutional capital into the property sector. And I think it was a pretty innovative way to try and deploy capital into the sector and create that liquidity. And that model has obviously now grown from the US across to different regions, or should I say some of the more mature capital markets globally. That includes the UK, Europe, as well as in Asia as well. And more recently, I guess, in the GCC. And when I say most recently, it's still been in excess of, I guess, more than 10 years now. But at the same time, it has definitely been an asset class that has been around for a while. And I would say tracking the performance of REITs over the last 5 years, which is we've seen a fair amount of disruptions in the market, right? We've seen the disruption due to COVID. We saw the disruption due to the rate rises across the globe, as well as inflation. And I think that obviously that has had a pretty profound impact on the capital markets globally, I would say. And that has a direct impact on the REITs. Moving on to the GCC side of it, obviously, I mean, that's it's a relatively new entrant in the REIT space from a global perspective. It's ironical because when you look at GCC basically is really a large part of the capital that kind of flows out into the other parts of the world in the public capital markets, and it should really naturally be flowing through into the local REIT structures as well. I'm not so sure that has really happened to its fullest extent, and maybe that's just a function of the changes that are yet to come. But broadly speaking, the REITs have continued to perform from a standpoint of fundamentally asset performance-wise performed okay, because fundamentals have remained the same. It has remained resilient, but the capital markets have been very disruptive, and that has really had an impact on the overall valuation. So yes, there's been a fair amount of stress over the last 5 years. And it probably goes the same with GCC as well. The operational aspect of the real estate and the fundamentals of the real estate, and they've remained strong in most of the regions globally, I would say. And the reason why I say that is just because it's a matter of supply and demand, right? Like this, just given the level of stress in the system or in the markets, credit hasn't really flown through. And when credit hasn't flown through, people haven't had a chance to build more. And as they haven't really built more, and the fundamental demand's still been strong. And with that, you really have supply-demand mismatch. And that's why, operationally speaking, real estate's done well. We've seen this happen here in Europe, as well as in the UK, as well as in the US, for that matter, to an extent as well. And probably the same with GCC as well. Like, it's just a supply-demand mismatch. And that has led to fundamental performance of the real estate being resilient and strong. Now, it's really the capital markets that have been disrupted. I mean, when I say the capital markets, means just the flow of credit, the rate narrative, inflation, and that's really has had an impact. The REIT sector, it's a very unique structure in the market. It has gone through a period of kind of stress, but I think fundamentally it's still a resilient sector. It's just a matter of the capital markets being supportive in the long run. You really have to look at some of the more mature REIT markets in the world, more from a global perspective, and see, what are the key asset classes which have successfully, performed, or should I say, have led to the formation of the REITs. I would say office, retail, logistics, hospitality, some of the other alternative asset classes like self-storage, multifamily, big one. So these are all the key asset classes that you see has some form of REIT presence in all the mature markets, whether it is in the US, whether it is in Europe, whether it is in the UK. Those asset classes or property types where you have substantial amount of, traction in terms of scale, those are the ones that should lead to the formation of REITs in that particular asset classes. When you talk about traditional real estate investment, you think about it a little more from a standpoint of retail investors and some of the institutional investors, right? And some of the smaller institutional investors, I would say specifically. For them to get an allocation in traditional real estate investment is just not being easy, right? Because there's not enough liquidity. The promoters and the developers who really build these assets, right? I mean, they're looking for capital. They kind of tap into some of the larger avenues in terms of sourcing their capital needs, which tend to be larger institutions, right? Whether it's the sovereign funds, whether it's the pension funds or insurance companies or so. But you really don't see the retail investors and some of those smaller institutions that kind of are able to kind of come in, put their capital to work in that particular in that asset class, right? I mean, the way to think about it is if you were to say that, okay, if you specifically wanted to invest in office, how would you do that, right? And the only way you could do that is through REITs. And so there's a lot of capital that can actually flow into the sector and create a right amount of liquidity, both for the investors as well as for the developers, and lead to fundamental growth in that particular asset class as well as in that region. Traditional real estate has always been capitalized by some of the larger pools of capital, and REITs gives the opportunity for some of the other sources of capital which don't have access to the traditional real estate investment can get access to the real estate, should I say, exposure. And then REITs, or the individual sponsorships of the REITs, will obviously stand the benefit of far greater liquidity for the purposes of capitalizing their investments going forward. So the pros and cons are, when you are investing in REITs, the expectation here really tends to be from investors is that you need a consistent dividend yield, right? So the profile of the assets that really go into that structure are more stabilized assets, which are long-term let or have fundamental performance, which is undeterred, so to say. Whereas the traditional real estate investments allow for actual development, right? So if I want to go out and develop a large office complex, right, like you cannot put that in a REIT structure. What you can do is, and that's why traditionally speaking, it is when on the private side of the market rather than in the public side. That's not having said that like the REITs don't do developments themselves. They do, but it's just a matter of how they capitalize, but they need to focus and ensure that they have a large enough kind of portfolio to provide that liquidity for their investors in terms of a dividend yield. Traditional real estate investments on the private side don't have that criteria, and that's why that has really kind of thrived and have moved in scale and size over the years, and REITs have, over the last, I would say, few decades, is when they are now really coming into the mainstream on the investment side. REITs provide the liquidity to, I would say, the retail investors and the institutions, as well as a consistent dividend payment, plus, more importantly, a tax advantage. The whole purpose of REITs was really largely driven by the tax code in the US, and that's really the reason for their formation. So that's the benefit of the REITs. The traditional real estate or the private real estate is really, really good for deploying large pools of capital into investment opportunities and truly getting more opportunistic kind of returns, probably taking more risk on the private real estate side, but getting paid for that. And so I think that's really the differentiation between the two of them. The regulators have been very proactive in some of these mature markets in terms of making sure that it's more efficient for flow of capital, from whether it's from the retail investors or from institutions into the REIT sector. In the GCC, obviously, it's still a very nascent kind of a product, and regulations are going to be key part of making sure that sector kind of grows in scale and size. And by regulations, I specifically, imply around the tax part of it, providing the right kind of tax benefits, providing the right kind of flow of information from the companies or these REIT structures or these REITs to their investors. That transparency, the corporate governance is huge, right? I mean, so all these factors have to be taken into consideration and need to be, addressed by the regulators so that the investors can get confident. They have the confidence of then deploying capital into these structures. It's really going to be a big push by the regulators to ensure the success of this structure in the capital markets. Amongst the key frameworks, I would say corporate governance is probably be on the top of the list to ensure this transparency of flow of information in terms of from the company over to the investors. The REITs, typically speaking, they work on very, I would say, modest amount of leverage. It's just the nature of the industry. And that leverage really needs to come from financial institutions. It needs to come from the banks, it needs to come from insurance companies and other institutions. So banks play a very, very big role. They play a role in terms of making sure that the distribution of the ownership of the stock or the stock issued by the REITs flow into on the end user side, whether it is on the retail side, whether it is on the institutional side. So for them to be the book runners and the underwriters for these issuances, that's critical. For them to provide financing solutions for the REITs as and when they are formed, very critical. When you talk about banks like Mashreq, I mean, these are well-capitalized institutions who would play a very, very important part in the overall ecosystem going forward, right? Especially in terms of development of these streets. Because the thing is, they've also been, interestingly, they are already part of the ecosystem, because even when a company or a real estate company goes from private to public, they are the banks that actually provide the required financing for those institutions. And as and then when they move into a REIT structure, they will continue to be there. They will help them, promote, or should I say, help them transition from that one private structure into more of a public structure. So the banks are going to play a very, very big role here. And Mashreq, like as an institution which is very well capitalized, it's going to, they've got a lot to do and a lot to help here to try and make sure that this structure can actually be successful in the GCC region. Globally, it's an asset class which is well embraced by the investment community. The regulators ensure that the investors that invest in these structures, they are well protected. They have the right amount of transparency in terms of their investments. Going forward, you will see, especially in some of the markets which are in the process, like being, I wouldn't say emerging markets, but like at least, how are relatively mature markets, and there is a substantial flow of capital that is already sitting on the sidelines, which can actually flow into the REIT structures, whether it's India, right? I mean, India has seen a flurry of activity when it comes to the REIT structures. And so even in GCC, right, for that matter, I think there's a huge opportunity for flow of capital into the REIT structures. It's just a matter of, the challenge is really going to be to ensure that the regulators have, a robust kind of a framework that is in place to protect the investments that kind of the retail investors as well as institutions that go into these REIT structures. So I think the key challenge is really going to be, ensuring that the regulators are proactive enough and are focused enough to have the right regime and the right level of transparency for these investors. Another consideration really also is going to be in terms of creating the right product. When I say right product, means if you're really creating a REIT, right, you want to ensure that you have the right asset class identified with the right amount of, should I say, track record to ensure that you can, on a consistent basis, provide the returns that you are telling your investors that you will be looking to provide. That's also a very important consideration, that you find the right product around which you want to try and put this wrapper of the REIT structure, and so that you creating that opportunity for investors to deploy their capital into that specific asset class, which is fundamentally robust as well as has a fair amount of track record to ensure that there's no disruption in terms of the value creation process, as well as an economic impact to the investors. So I think the key point is going to be identifying the right risk-adjusted return for the specific REIT that you're investing in, the right asset class, right? What is really the upside going forward for that particular asset class? And I think that the third critical point is really going to be the sponsorship. What's their track record, right? I mean, how have they behaved as a partner for their investors? That is a huge point of consideration. So I think those are the key takeaways for someone who's really looking for an exposure in this particular asset class.